I hear you're up like all night doing this note for my show. Thank you.
Pretty much the case. You know, got to do the research, got to publish, and then we talk about it with clients.
So the headline from it is that basically you're looking at no earnings growth now for the S&P this year and only 6% for next year.
Correct. Previously, we had been anticipating earnings growth this year, roughly 5 to 6%, and continuing next year because the broad expectation is the U.S. economy growing this year and growing next year. And that still remains the expectation that we'll have economic growth this year, just that the earnings for corporations are likely to basically not be non-existent this year. So expectation now is we have no earnings growth in 2020, and then we rebound and have a little bit faster growth next year.
So that implies a V-shaped recovery for earnings as well, right? Because in your target for the S&P, you're looking at weaker first half, and the back half you still see the potential to hit 3,400, right?
Correct. So we want to think about it right now. The downside for the path of the market falling to around 2,900. So middle of the year, and then rallying back to around 3,400. And the reason for that partly is the interplay between the prospects for economic growth and also the interest rate levels. And so likely we have bond yields now around 1.3%. And so while there's no earnings growth in our forecast, we have interest rates that are actually have fallen quite a lot, and probably end the year close to 1.5%, but could get lower even in the middle part of the year. So that
offsetting
the worst, yeah, the interplay between the rates and the level of profits. And then as you look into 2021, we're still likely to get some level of earnings growth.